In our recent fast-paced financial heydays, it was normal to endow credit rating agencies with a legitimacy and a power that has since fallen into question, if not outright scrutiny. One of those people leading the scrutiny is ESSEC professor of economics, Patricia Langohr, who with her father, INSEAD finance professor, Erwig Langohr, has written a book on the subject. It's called The Rating Agencies and Their Credit Ratings, What They Are, How They Work, and why they are relevant. Welcome.
Thank you. So we've been working on this book for a couple of years actually, and our vision for this book actually came after the first burst of the bubble with the Enron and the WorldCom. And the rating agencies tend to come in the spotlight very often with these bubbles. And what we noticed is that credit ratings are ubiquitous, they're arcane, and they trigger tremendous transfers of wealth when they come into play.
They've lost a lot of credibility. You mentioned two big cases. Right now, a lot of the mortgage-backed securities were rated AAA. Clearly that was a mess. What's going to make them a little more credible?
What will make them more credible is the usage of the ratings in a more diligent way. So we tend to take ratings at their face value and to make decisions based solely on the ratings. And this definitely has led us in wrong directions. And the credibility will come with better regulations and better quality ratings and uses over time.
What is a credit rating really? How should you use it? Was it overemphasized recently in the last bubble and in other things that you've just pointed out?
We believe that credit ratings are not accurately understood, and what a credit rating really is a benchmark measure of a probability of default. And more than that, we realize that its use over time gave it more role than just this measure. And it really has three different roles. And they are, first, they're the measure of probability of default. And moreover, they're used to compare products across segments. So a corporate bond, rating of a corporate bond in a given country in a given segment is means the same as a rating of the same level, say a AA in another country, in another type of bond, in another segment. And rating agencies work extremely hard to make that comparison possible. And last but not least, what differentiates them from, say, CDS swaps or other market-implied ratings is the fact that they're contractable. They're very visible, and you can verify at a given point in time what that credit rating will be. And because of that, many regulations are based on credit ratings. Many contracts use ratings as triggers. And many investors have investment guidelines based on ratings. So whenever a rating moves, eventually a lot of capital will move directly when the rating changes.
What skill sets are necessary to be working in this arena, the credit rating arena?
So most of all, I would say really the profound will and to get the rating right. Really, what really drives these analysts is to get the rating right. So they are not typically commercially driven. They don't wield very high salaries, at least compared to their opportunity cost in investment banking. And they really have an atmosphere of, quite collegial atmosphere of analysis. So I would say it's really analytical power and independence of mind.
Do credit rating agencies ever refuse to rate something, or should they in the future refuse to rate more things, just say, we don't know enough about this yet?
Yes, that is really the key to what should happen. I believe that they will gain their credibility once they dare say no to rating a specific product now, because this is one of the problems with bubbles, for instance, and especially with the structured finance segment, is that the short-term interest of rating a little more even if the information was not sufficient good, was at the end was affecting their bottom line more than their long-run reputation. And their long-run reputation will only come back once they dare say, no, we're not rating you, we don't have enough information, and our reputation is at stake, we cannot do it. But that will only happen if investors really monitor the reputation and how good the rating agencies are.
And use other barometers for their own investments.
Exactly. And that only will happen if regulators don't certify the rating agencies. And I'm very concerned about some of the regulation coming out.
Can you give me an example? I mean, it's still in flux. So
exactly. It's still in flux, and there's been excellent proposals, for instance, by the SEC to take away references from references of ratings in their most of their regulations, but Europe was on a good track with a code of conduct and not too intrusive, no certification, and now they've come up with regulation that is much more intrusive, and certainly we need to monitor the rating agency closely, but certifying gives a false sense of security to investors, and what we really want is investors rating the rating agencies.
That goes back to an inherent conflict of interest in the way the agencies are set up in the first place.
Exactly.
I mean, who pays them? The issuers.
The issuers, exactly. So you pay the one who's supposed to give you a grade or to rate you. That comes back from the mid-70s, actually, where the business model before was based on investors paying the rating agencies. And so there was a problem with that, is that obviously the willingness to pay for an investor for a rating is much lower than an issuer's willingness to pay. An investor, if he doesn't have a rating on a given company, he will just invest in another company that has a rating. And whereas an issuer, if he has no rating, he cannot go on the capital markets. So rating agencies needed more money for more thorough analysis, and capital markets could not function with secret ratings that would become public after 5, maybe say a couple of key investors had the ratings, and you would see in the prices that ratings would be revealed. So the investor pays models is not sustainable, and the issuer pays for the rating has its problems, but in the corporate segment, it has actually worked really well. When you look at the performance statistics, it has worked well in the past, except when you get into bubbles. And one of the dangers that has occurred is that nationally rated statistical organizations, so that S&P, Moody's, and Fitch were protected because of these regulations, and based on these firms, they weren't too worried about their demand. There's only 3 firms who rate all the bonds outstanding in the world. So obviously they're not too worried about losing their business. And but the threat of having new rating agencies coming in is really what should maintain pressure on them on performing well.
And do you think that's what's going to happen? What do you see down the road for credit?
Yes, I think this is what should be happening, and we've seen new nationally rated statistical organizations, but that will only happen if we give them sufficient room, and if they get enough opportunities to rate issues. So it's not sure if regulators protect the incumbents too much, say now with the European regulation or with capital requirements directives that are based on some ratings, and these ratings have to be from the 3 or 4 main ones, well, that protects the market too much. And it will depend if investors really start seeing, well, S&P, okay, we feel secure, many other investors use S&P, but maybe we should look at these other rating agencies and what they have to offer. But it requires a lot of homework.
It would be interesting to see how that plays out.
Yes.
Thank you very much, Patricia Langohr.